Good afternoon, and welcome to this next episode of Governance Dialogues. My name is Elisa Cole, and I'm the Managing Director of Governance Center. It is my pleasure for those of you who are joining us once again for this episode to welcome you on Governance Dialogues for what I believe will be a fascinating conversation around a very interesting governance topic. And today's episode, as you might have noticed, is called "What is the Corporate Governance Gap?" And it's a term that I've actually borrowed from an article from a very interesting research paper that was authored by Yaron Nili, who is joining us today from the United States. And in this report, the authors are actually exploring a very interesting governance phenomenon, and that is the difference in corporate governance practices between large cap and small cap companies. Yaron, welcome to this episode. It's a pleasure to have you with us today.
Thank you for having me. I'm excited to be here.
Thank you. And so let us, just before we dive in this conversation today, perhaps take a step back and I'll give a little bit of context on your work, but also on why this corporate governance gap is, I believe, important to discuss today. And as we all know, sort of for the last 2 years, for those of you obviously who follow financial press, companies like Amazon and Alphabet and many others are, of course, in the front lines of the discussion. The unicorns of this world are the ones who are gathering sort of most attention for reasons that, of course, do make sense on one part. And these companies are, in fact, the reason why equity markets have been, I believe, lifted out of the red into the green over the last 2 years. As well as obviously expansive monetary policies that we've seen during this period. And yet, when we think about the world of securities regulators and other regulators looking to attract or develop capital markets, they're very much thinking of the smaller and mid-cap companies and ways to attract them. Jobs Act in the United States is obviously one example of a measure that was taken to attract these smaller companies. But also stock exchanges all over the world have, in many cases, introduced tiered listing requirements whereby smaller companies are subject to perhaps less disclosure rules or less rigorous corporate governance rules. And if you look even in the EU, some of the EU ESG requirements that they're not specifically targeted at smaller companies do effectively, in a way, exclude them because they are focused on large cap companies, those with more than 500 employees. And so most of these sort of ESG type measures in the EU are currently focused around these companies that are essentially about 12,000 of them that are covered by the directive. So clearly, if we look at this sort of polarity, size does matter. And when we advise regulators on these issues, of course, these nuances are important to address. And, you can't just create a world of best class corporate governance rules that fits all types of companies. And Yaron, this is really the core of our conversation or subject that I would like to discuss. Let me introduce you for a second and your work before we jump into this this very interesting report that you've authored and you've recently put out together with Kobe Castiel. You are a professor at the University of Wisconsin Law School, and your work is obviously, which I've been following, has been published in Harvard Law Review and also the Yale Law Journal and many other prestigious sources. And I think this particular piece adds a very interesting angle that has not been very much covered either in the financial press or in the corporate governance literature. Could you perhaps start off by telling us a little bit more about this corporate governance gap and paint us a little bit of a picture as to where you see things stand today based on your research?
Yeah, thank you. So, let me just start. I can tell the listeners kind of like how this topic came about, and it really stems from a previous project that Kobe and I worked on corporate gadflies. That's another unique feature of the United States where we have these individuals who submit shareholder proposals to companies. They have been kind of nicknamed gadflies because they're pesky and annoying to companies. And when we worked on that project, one thing that we saw that really kind of made us really curious is that they have concentrated only on S&P 500 companies. So there's was stark difference between the level of proposals submitted to S&P 500 companies compared to everybody else. And we told ourselves, that's interesting. We should look more carefully on kind of the variance between large and small companies. So that kind of like brought us to explore this topic empirically. And as we started to work on it, we found very interesting disparities in the way corporate governance is evident or present in companies of different size. So we looked at, we took several key governance topics, and we tried to trace them over 15 to 20 years to see kind of like how they evolve over time and whether we see differences. And some of them are kind of well-known, staggered board or classified boards, basically the ability to only replace the board once every, a third of the board every year. So it takes longer to complete a takeover of the company. Majority voting standard for directors, the ability to amend the charter, or supermajority requirement to amend the charter. Again, it makes it more difficult for shareholders to make changes in the governance arrangements. Proxy access, something that has been really big in the United States. Issues regarding to directors, so their independence, diversity of directors. And in all of those metrics, we saw really a story that is consistent, where S&P 500 companies are basically showing high levels of adoptions of governance arrangements that investors really want or indicated that they perceive as really good. And then as we go down in the market cap to the S&P 400, 600, and then into the bottom of the Russell 3000, we see kind of graduation where you see less and less of those practices adopted. Sometimes even the trend lines are actually walking in opposite directions. So in some of the issues that we review, we see that, well, let's say classified boards, right? So generally speaking, investors are really opposed to that. They want to have at least the threat of hostile takeover as a disciplining management mechanism. And while in the S&P 500 and even in the S&P 400 and 600, we see a decrease of the presence of classified boards in those companies. In the smallest of companies, we actually see an increase in those arrangements. So that's kind of descriptively, we just observe a serious gap in the governance of large and small companies. And the second thing we do empirically is also try to look at the forces that might explain how governance is adopted and why they may be operating differently. So we look at shareholder proposals. And again, that's something that we already kind of knew from the previous project, but clearly shareholder proposals are a very effective mechanism to nudge companies to start adopting governance changes. So while most shareholder proposals are not mandatory, they are what we call precatory. So shareholders are only asking companies to act, but can't force them. In the United States, because of the dynamics of the market, where if companies don't follow up on proposals that got shareholder support, they get punished by ISS and Glass Lewis. In reality, most proposals that pass get adopted by companies. So that's a very important tool that shareholders have. And it has been almost exclusively being used in larger companies, which explain why those companies tend to adopt shareholder wanted arrangements. We also looked at the big three, and we saw that they engage with companies on a regular basis through calls, through meetings, and they disclose that engagement in their filings. So we looked at the big three engagement with companies, and we saw that disproportionately they engage with larger companies. Again, that can explain why we don't see that push for governance arrangements in smaller companies.
Interesting that you mentioned sort of institutional investors and their influence on these companies. And in fact, this was something we were discussing in the previous episode on this program with respect to institutional investor engagement in some emerging markets, whereby they make stated commitments in their voting policies around, for example, gender diversity on boards. But in reality, in some emerging markets, they don't actually engage in any shareholder action on this front. So it's said, but not necessarily followed.
Yeah.
And what I'd like to ask you because your work or this report, I know, focused specifically on the US market. So let me bring it back to that, to your research. And I'd like to ask you, what are the biggest let's call them anomalies from a corporate governance perspective that you found in these small cap firms? Is it classified boards? Is it weaker disclosure? Sort of from an investor point of view, if you're looking at these companies as a real investment prospect, what are the let's say the top 3 things that you would look at and say, those are the things that sort of raise real red flags that I wouldn't want to be exposed to as an investor, where, practices that, let's say, are either phasing out or no longer really exist in the S&P 500 firms?
Yeah, that's a great question. Before that, I'll just add some interesting nitbit here. That's institutional investors sometimes actually specifically only target in their guidelines. Not only, I know you made the distinction that sometimes they've stated policy that they not act on it. Sometimes the stated policies only focus on S&P 500 companies. There are a few cases where they specifically mention that they're only looking at the S&P 500 expectations. So that's another kind of interesting tidbit. But on your broader question, I think it's easy or tempting to kind of try to look at 1 or 2 arrangements and say those are like the most worrisome or not. I think for Kobe myself, the argument is a little bit more nuanced in the sense that I don't think, there are cases where smaller companies might actually merit, not having those governance arrangements. So like having a classified board or having, dual class voting structure. I don't think we are making an argument that those arrangements are always good. I think what we find, and this is the concerning aspect, is that it's across the board, we see that kind of difference, right? So it's not just one metric or the other. It's like on every parameter we have looked, we have seen a gap between larger and smaller companies. And then we were also able to trace it and explain it by the fact that the market forces that the US is so dependent on in kind of like saying that the corporate governance system is working well, just don't work the same way on larger and smaller companies. There's maybe more friction in those smaller companies, and that creates a cumulative effect where investors can't be sure that the arrangement that they're seeing is the product of actually intentional kind of like back and forth between shareholders and management, but rather just kind of maybe one-sided decision by the management team. And that should be a concern. So, if I had to kind of broadly say what would be concerning to me the most, smaller companies have really bad disclosure. So that's a concern. So investors often don't even know what's going on there. And they don't really comply sometimes with the requirement of disclosure, or, they just the minimum that is needed. And I think generally speaking, having mechanisms that insulate them from shareholder pressure would be worrisome, not because those mechanisms are not good on their own. It also indicates maybe less of ability of shareholders to kind of negotiate with management on things that might be improving the company's governance arrangements overall.
That's interesting, and I think we are covered in your comments. You've covered quite well, kind of the big 3 or the larger. The larger investors and their, let's say, lack of interest. And we've discussed this on this program also on a number of occasions, also with respect to capacity and expectations that the BlackRocks and the Vanguards of this world have the capacity to sort of engage with all of their portfolio, which, let's say, is a little bit of a perhaps of a stretch of reality. But one thing that I also zoomed into that you highlight in this paper is retail investors, and we kind of no longer think of the world of retail investors. We tend to think that in the US and also in London and a few other markets, we're in the world of institutional shareholders. Those are the guys that call the shots. And yet in your paper, you talk about some impacts and risks to retail investors, especially in light of mobile trading apps like Robinhood, which have over the last, I think perhaps year or 2, have also kind of increased retail investor participation, perhaps not as an ownership of the overall market, but in terms of kind of the actual trading activity. And I wonder if you could say a few words about this world of small caps and retail investors. How does that play out?
Yeah, so I think that's a big development in the corporate governance landscape in the United States that kind of merits some rethinking about what we focus on. And I think while traditionally, retail investors were invested in all companies, there's been kind of like overall a gradual over time movement from retail holding into kind of mutual funds and kind of institutional share ownership. But I think with the gamification of investing over the last 2 years and kind of like more ease of accessing financial markets and just the millennial people who are like more comfortable just putting their kind of like taking investments based on kind of hype or stuff like that, we see much more willingness to invest in companies that are smaller cap and maybe based on a very shallow understanding of what the company is or what the company's arrangements or governance arrangement that you're buying into. And therefore, to the extent the US markets are trying to protect retail investors, which is a somewhat of a stated goal of the SEC, for instance, then you should be concerned about kind of this access of investors into smaller companies where they really don't have an understanding of what's going on. They might have an expectation that all companies in the United States have some baseline governance protections, which might not be the case. And also, once they already enter, those companies might have less liquidity. They might create some other issues for them that at that point, they won't be able to kind of self-correct. So to me, retail investors create some stress on the governance landscape overall, but it might be particularly concerning as they get access to more and more companies that were traditionally out of their reach because of the fact that they're smaller and not as traded as other larger companies. So that's an interesting thing to observe. And I think this understanding that those companies tend to have worse governance arrangements creates this paradoxical effect where the people we're trying to protect most, which are the retail investors, are actually buying into the companies that have the worst protection mechanisms for shareholders. So that's an important point.
But it's very interesting. You were mentioning in your comments that that there is a particular risk to retail investors from these small cap companies, and indeed, I think it's a point that is of great interest to securities regulators worldwide. Because a number of them have actually introduced particular requirements or limitations for companies listed on secondary listing tiers, being, for example, only investable by qualified institutional investors. And this is not really the case in the US, but it is the case in other markets. Which brings me to an interesting point of in this conversation, and that is your paper is specifically looking at this gap, this corporate governance gap in the US market. And what I'm wondering is if you could perhaps say a few words, perhaps speculate whether you think that this corporate governance gap would be as important as it is in the US, in, let's say, London or in other emerging markets, or do you think it is more of a US phenomenon due to the way corporate governance rules are actually set in the US and the fact that stock exchanges have perhaps a higher, let's say, regulatory power than in other markets?
So I think that's a very interesting and complex question. I think broadly speaking, the United States is somewhat of an outlier where we don't see a lot of regulatory intervention in how corporate governance is being handled. Even the UK, which is the closest kind of country as far as kind of like the corporate landscape is to the United States, is much more heavily involved in putting some standards that are enforced on governance issues. And then if you move to kind of more continental Europe and the Asian countries, you see much more of a regulatory approach on how what you expect companies to have and don't have. There are benefits and disadvantages to kind of whether you go with kind of self-regulation versus kind of mandatory regulation. I think the US is a little bit different, and I think the gap is different. You can have a gap, and I think based on your introductory, in the introduction that you made some references that, the gap can be created by different forces. So I think if you see a gap in Europe or elsewhere in the world, that is probably by a design choice of regulators to either focus on larger companies or make it easier for smaller companies. And it can be easily corrected by modifying the regulation. I think what's unique in the United States is that the gap is the creation of the forces that, you know, advance governance in the United States are private forces. So it's shareholders, it's stock exchanges, it's activist hedge funds. It's somewhat of societal pressure, especially lately with stakeholderism. But all of those tend to work on a subset of companies much more effectively than the other. And you know, in that sense, I think that's a unique feature of the United States, where we depend on those forces to advance corporate governance, and those forces just have much more friction and hard time doing their job in the smaller companies. So to us, this paper is, you know, I know it's kind of like very interesting to see the actual gap, but I think the most important thing to take away from this paper is that the gap is created because, you know, the forces we rely on just don't work the same on larger and smaller companies. And you know, in itself, that process of push and pull between management and shareholders is very important. Even if the outcome is different amongst companies, we just want to make sure that that is something that happens, and that shareholders are actually making an informed choice, that one company will have staggered board and some other company wouldn't. And we just don't see that in smaller companies. That it just doesn't happen.
Absolutely. And to come back to regulators, because obviously they're an important part of this this puzzle. And I mentioned in my comments, and obviously you know that regulators, but also stock exchanges, have been creating different mechanisms to essentially seduce these small cap companies to come and list on secondary listing tiers. And in a way, perhaps that has also contributed to this corporate governance gap. And do you think that strategy, or that sort of seduction strategy, so to speak, is in a way partly responsible for this corporate governance gap? And is there even a way around that regulators and exchanges might have to attract companies without, let's say, lowering requirements for them to list, smaller companies, that is?
Yeah, that's so I kind of alluded to it in my previous answer, and I think that's an interesting observation. I think specifically in the United States, I don't think we can. I don't think there's the cost of being public are specifically associated with the gap that we are finding. So yeah, there are costs of being public, and you know, in the United States, there's been effort to reduce that listing costs by giving some, you know, as you mentioned in the Jobs Act, some emerging growth companies are getting some latitude in what they need to comply with, but that is mostly on the securities compliance part, not on the corporate governance arrangements. And there is a question, and you know, companies can choose to do whatever they want. So as you mentioned, some companies are coming out into the market with dual class and protections to their founders and all of that. And there's, you know, every debate whether this is beneficial or not beneficial. I don't think we want to make a strong statement there. I think the notion is that across all metrics, we see just differences, even in things that basically are not very costly for companies, right? So the tenure of director, the independence of director. And what's also important to highlight is that we're not just, the gap is evident not only between, you know, let's say Apple and some, you know, the 2,999 company in the Russell 3000. It is also between even companies that are in the S&P 500 and companies that are in the S&P 400 and 600. So even relatively large companies, mid-cap companies in the United States that are significant and have a large impact on investors, have a large market cap, are still showing different governance compared to the largest of companies. So in that sense, yeah, I think you can make an argument that smallest companies, if you want to bring them into the public markets and give investors the ability to participate and benefit from that investment, you can make an argument that you may want to give them some benefits or excuse them from some requirements of securities laws. But I don't think what we're seeing is that. We're seeing just companies that are just not subject to the same interaction after they became public. So that's not a question of being public, it's a question of what happens after you become public. And importantly, we see this not just with new companies. So you can make, when we kind of worked on the paper, people made an excellent comment of maybe what you're observing is a gap because companies that are newer are smaller, and as they mature, they adopt governance policies and become better. And what we see in the paper is that that's not the case. We see that the gap is evident from year zero, but it's basically stays regardless of companies' age. And even in companies are very mature, still, if they're smaller companies, they have different governance, arrangements compared to similarly sized, similarly aged companies that are larger.
It's an interesting aspect that you're mentioning about sort of age and also size. And one of the sort of, if I may ask, might indulge myself in last question around a particularly important governance characteristic of that you mentioned in your research, but I think is also something that's been very much discussed with pros and cons being mentioned on both sides, and that's around concentrated ownership, which you also observe is one of the key characteristics of these small cap firms. But also, as you mentioned the example of Apple and we talked about Alphabet and others, many of these large cap companies also have very concentrated ownership that will likely stay so because they have multiple class shares that enshrine very specifically and through specific legal arrangements these multiple the long-term shareholders of these multiple class shares. And many securities regulators are actually in fact in favor of loyalty shares and other mechanisms to essentially give founders greater voting rights. I wonder if to close our conversation, if you would mind saying a few words about what your thoughts are on these type of arrangements, and what are potentially the risks of concentrated ownership in these small cap firms that you've looked at in your piece? Yeah,
that's a good question. So let me start by maybe emphasizing that we so-called controlled for the fact that some companies are controlled by shareholders. So we find this gap to still be pervasive, even if you kind of remove the controlled companies from the sample, even if you kind of account for the fact that there are a little bit more controlled companies in smaller cap companies compared to larger cap companies. So the gap is evident even if you take that into account. But more specifically on the question of whether we want to have dual class or controlling shareholder, and kind of what are the benefits of founders who are able to kind of pursue their vision of the company. I think most people, nowadays, most scholars kind of accept the fact that sometimes it's advantageous for companies to have to protect founder vision by giving them outsized control compared to their equity. I think the discourse now has shifted a little bit, and basically the question is for how long, right? So right now, dual class companies are often able to maintain that structure into indefinite time horizon, and I think a lot of scholars are kind of urging companies to consider sunset provisions, where the founder can get that outsized control, but at some point it might not make sense for that founder to maintain that, and shareholders should get an input on whether to extend it or not. And I think that's an important observation. It connects to a second point where, in the smaller cap companies, you'll have some companies that have founder vision, but often you also have cases where companies are actually having some sort of a family type of control that is passed along over time. That might not be the most efficient way to run the company. It's not necessarily that it's not a monarchy where you pass it along, and even monarchy has proven that it's an issue. So wanting to have the right management team in place to kind of take the company where it can go is very important. And sometimes when you have a controlling shareholder, that's not the case. If it's a founder with a vision, there are legitimate reasons to kind of think that's optimal, but a lot of cases where we have this situation where it's a smaller company, investors are buying in, and that company is basically extracting value from shareholders to the pockets of the controlling shareholder, either through tunneling or through other mismanagement, and that should be a concern. And if we don't have governance mechanisms that are effectively trying to mitigate that, and in small companies we see them less often, that should be even more of concern.
A bigger concern. Yeah, I agree with you, and I invite our viewers to actually have a read of the paper, and we'll put a link at the bottom of the video to the report, which I found quite fascinating in this world, which frankly I think a lot of financial press doesn't really look at, and it's sort of looking under the covers and seeing what's beneath there. So thank you, Yaron, for joining us and for taking the time to talk about the risks that investors and others looking at financial markets may face when they're investing in these companies, and some of the common points and specific challenges to the small caps. So thank you for joining us today.
It was my pleasure. Thank you so much for having me.
And for our viewers, for our audience, we'll be continuing to delve in these various, which I believe are fascinating corporate governance questions in future episodes, looking at specific emerging markets and future corporate governance challenges that we'll be exploring with you on future episodes of this program. Thank you for joining us.